All right, cool. Welcome everybody to the first actual lesson in the course or the platform, whatever you want to call it, right? And so now this is exactly where we're. All right, cool. Welcome everybody to the first actual lesson in the course or the platform, whatever you want to call it, right? And so now this is exactly where we're going to get into the actual real stuff, etc., etc. Um, So all I ask from here is for you guys to actually listen to what I have to say, because this is exactly how I go about my way of looking at the charts, right? And I'm not here to tell you this is exactly what how I want you to trade. I want you guys to adapt this stuff and make it your own, because that's exactly how you're going to get your own interpretation, and that's how you're going to beat your learning curve. So yeah, let's get to it. This is market structure, and honestly, it may seem very basic, very typical of what kind of every course does market structure, blah, blah, blah. But there's little details in structure that people don't understand, and that literally is the source of why they lose trades. Like, if you really pay attention, every single pair, if you zoom out to, let's say, weekly, monthly time frame, even 3 month or 6 month, 12 month, you're going to see exactly why a pair went to the place where it is at currently. And that's just because structure tells you everything. And obviously you start from the weekly, and the study that I'm going to use for this video is EURUSD is AUD and this is given out basically over 1,000 pips in 2 weeks, and that's as of now. And you can blame it on whatever coronavirus, this and that, whatever, blah blah blah. But what you got to realize is the candles will tell you everything you want to know. It's going to tell you, right? And when it comes to structure, like, you got to understand, when you're in a downtrend, you always have to analyze those lower highs, right? There's these two rules that I'm going to tell you, and I'll probably put them in the description of the video, but there's two things you always have to consider when you're looking at structure. And that is when you cannot assume a change of bearish to bullish market unless a lower high is noticeably taken out, right? And you cannot assume a break of bullish structure until a higher low is noticeably taken out. So what does that mean? So in these, for example, in this whole sequence of AUD USD, we're looking at this range from mid 2018, mid to start of 2018 to now 2020, right? And what we have to understand here, right? We have the high, right? Low, then we have a lower high, lower high. The lower lows are irrelevant to me. All that matters is that the lower highs maintain, right? All these lower highs have maintained the entire way. And for those of you that remember, early of last year, this is almost a year ago, we had this flash crash. And what you got to understand about that flash crash is that could have either been what we're going to call later on as mitigation. That could have been considered just one big old FU wick to any type of liquidity to downside, or just anything like that. But what we have to understand is people will call this a rejection candle, but this doesn't matter unless the previous swing high breaks, right? So obviously the swing high didn't break, so where is price going to naturally go? It's going to roll over to the downside. And as you can see, every high structure point has failed to break the previous, these are basically weekly highs. But if you notice, every single move to the upside has failed to break a previous high. So that alone should tell you where price is going, right? Which is to the downside. Like, even here, we had people saying this was accumulation or massive rejection, whatever, but we didn't break structure high. So if that happens, if that's the case, then price is on, it can only go one direction. If it's not going up, it's going to go down. So understanding that bias, I'm going to use a study that this is how, like, basically how I went about a trade. And that is it was 1,000 pip swing from 11th of March. So this is recent. This is like 2 weeks ago, 3 weeks ago. Actually, a week ago. I'm sorry. So what we have to understand, right, is corrections versus impulse. And before I get to the charts, let's talk about that. So when we're talking impulse and correction, right, we're talking impulse, correction, impulse, correction, impulse, right? So what does that mean? That means that momentum is to the downside based off of just this boring little figure here. Momentum is to the downside, right? Price is struggling very hard to come back up. So if it's unsustained to go higher, then it's going to come lower, right? And that's exactly what happened here, right? Impulse, correction, impulse to downside. So our macro bias is to the downside because we've already discussed that based off of higher time frame, structure is to the downside. I don't care how big these wicks are, structure is to the downside. If anything, these wicks now, the bottom of the wick is target because there is liquidity sitting there, and we're gonna talk about that also down the road. But right now, all you want to focus on is structure, right? And a good way to understand your structure, right, is let's look at this range here. Let's remove this. Let's look at this range here. Okay, I'm sorry, hold on. Yeah, that messed up. I don't know what just happened. All right, cool. So we're looking at this range right here, right? We're gonna point out that high there, and we're gonna point out this low here. So we're now stuck in a range between, it's a 76 pig range, right? Cool. So what we have to understand is look at how fast this took to come down. And now look at how long price took to come up, right? So when looking at this took 3 hours to come down, but in order to retrace that same amount, it took 21 hours, almost a full day, right? So what do we conclude with that? We conclude that momentum is to the downside because it's struggling to go that high. And that's also going to connect to something we call the law of effort. And we're going to connect that later on. But we now understand structure is to, one, structure is to the downside from a macro term. 2, momentum is to the downside. So now 3, we should be looking at potential entries. And so now I have this zone marked up. And this is something we call inefficient pricing, which is something we'll get into down the road in the course. But obviously that was the entry. And so now we can start zooming in because we understand our higher time frame structure. We understand our mid to swing point structure. So now we got to hop into the intraday points of structure. And that's the point of this video, of this chart here, right? So if you notice, I marked out basically every red box as the correction to the upside, right? So now we created this wick here that rejected from our previous inefficient pricing. And we now created a higher low. But now notice this purple square right here. That showed that we could not take out the previous high, right? So even if you didn't take your risk at the high or even at the purple, you can be so much more conservative, and that's going to increase win rate so much. And so now notice once that purple square created a lower high, we now broke previous low, created a lower low, which means that our momentum is now starting to shift. So now every single pullback now will be opportunity to sell. And we see that change of momentum of direction through this red line here. That's considered your break of structure there. So if you can be conservative to the point where you now have confirmation of inefficient pricing and you now have confirmation of structure, you can literally become super conservative about it. But now once you learn how to actually enter trades with minimal to almost no stop loss or drawdown, then that's how you increase your win rate. And just by looking at that, this move, right? Imagine any type of 1% risk on a anywhere from 5 to 10 pip stop. You now continued the trend, you continued the wave, you have no worries, and this went for a total of 1,000 pips, and it's currently 800 pips. So that's insane, you know, like something so simple, right? Just because you can understand these smaller time frames with correlation to the bigger time frames, all through understanding structure, that is one massive move you can catch, right? And now this is the more simplified chart, right? Obviously, I highlighted the inefficient pricing, right? Break of structure, re-entry, and from here we gave that big move. So as you can see, structure alone will help you so much. So the takeaways here are obviously the two rules that I gave you, right? I'll say them again just so we can just go over them one last time. And that is, you cannot assume a break of a bearish market structure until a lower high is noticeably taken out. I want you to write that down, and I want you to study that, memorize that, live by that quote. And then also, you cannot assume a break of bullish market structure unless a higher low is noticeably taken out. Right? Just remember those two things, and I promise you, you're gonna see just massive improvement. It doesn't matter what entry techniques you know. It doesn't matter what trading style you do. As long as you understand those rules of structure, you're gonna see a massive difference. So yeah, that concludes market structure.